My name is Jonathan Weber. I'm the founder and publisher of New West and newwest.net. As many of you know, we started New West about 18 months ago, and the mission of the company really is to be about the large questions of growth and change in the Rocky Mountain West. This region is changing and transforming in an incredible way, and I think even much more quickly than a lot of people realize. And from a journalistic point of view, I'm a journalist by trade, and that is a very interesting and important story, important on many different levels. We launched newwest.net in the spring of last year, our online site, and we have local sites in 10 towns around the region. We're headquartered here in Missoula, and our journalistic mission with newwest.net is really to be about the large issues of growth and change in the Rocky Mountain West, as well as a number of other topics, including the lifestyle, politics, outdoor recreation. We cover a wide range of things there, but all generally tied into the broad issues of growth and change in the region. In my previous life, I had run a magazine, and one of the things that I learned in running that magazine was that conferences and live in-person meetings can be a very important dimension of what we're trying to do with the publication, and to really take the conversation that's happening online and make that an in-person conversation. And for our first large conference, it seemed that the issues of relating to real estate development were especially critical, and were a very good topic for this initial discussion. And we've really tried to do something with this event that I think is a little bit unusual, which is that we tried to marry, on the one hand, the public policy conversation that surrounds issues of growth and change, and all of the concerns about, how should that or should be managed or not managed, and what are the right policy approaches, and how can we grow in a way that's good for everybody, and to kind of marry that conversation with the business conversation about real estate. Real estate is a very important financial thing for many people individually, for many people professionally, and of course it's very closely related to the questions of growth and change, and those things are not always discussed in the same framework. So that was really the concept behind this conference. We really appreciate your being here. We've had a tremendous response to this event, which has been very, very gratifying for us. And I wanted to first off thank briefly our sponsors who have been very supportive. The Missoula Organization of Realtors in particular really got behind this early and was a huge help. Doutopoulos McDonald & Lynn, who hosted the reception last night. Vans Electronics, O'Berry Cavanaugh, First Security Bank, CTA Landworks, First American Title, Landwatch, Montana Water Trust, Refuge Sustainable Building, Dave Stauffer Consulting, American Conservation Real Estate, Montana Water Course, Hall & Hall, Mirror Rug Gallery, and DB Audio have all been a great help. And as you saw, there are display tables for the sponsors out in the lobby, and I encourage you to stop by and chat with the folks there. So one of the things that we have packed a huge amount into this program, which is a tremendous risk from a conference management standpoint. So I put a lot of burden on the staff, who I'll introduce a little later. But one of the things we're going to do to try to keep things moving quickly and on schedule, and make this kind of as rich and entertaining for you as possible, is that we are going to dispense with the formal introductions. The speaker bios are all in your program there, so you can read about the speakers, and if you do the math, we could probably save about 20 minutes over the course of the day by not doing a full introduction of all the speakers. So with that, and without further ado, I'd like to introduce the first panel. Now, just the concept for this morning, the first section of this event is really going to be about the real estate market. As you know, there's a lot of discussion about what's happening with real estate nationally, and whether there's a housing bubble that's bursting, whether we're in for a big downturn in real estate. That's a very pressing question for a lot of people. And so in this first morning session from now until the break, we're going to have two panels which really will try to get at that question, one from a sort of a broad national perspective, and then one from a from a local perspective. So with that, I'm delighted to introduce our first panel. We have Dave Kansas, who's the money and investing editor of the Wall Street Journal, Jonathan Schechter of the Chartreux Institute in Jackson, and Chris Thornburg of Beacon Economics. Thanks.
Good morning, I'm Dave Kansas, money investing editor of the Wall Street Journal. And I'm going to say a few words about how the national media, in particular, where I work, is viewing the real estate market, what's happening in real estate as it pertains to the economy. And then I'm going to talk a little bit about how the financial markets have been reacting, the messages they might be sending to us in terms of real estate, where real estate is a very important part of the market. And then Chris is going to present, Jonathan's going to present, and then if we have some time, we'll have a couple of quick questions. First of all, it's obvious that real estate is a very important story for the media, local and national. A good example of that is this week when the Federal Reserve Chief Ben Bernanke made some comments about problems in the real estate market that quickly became a page-one story for the Wall Street Journal, where he expressed some alarm at how the real estate market nationally was slowing down. And this has fed a lot of the discussion about the bubble bursting and how bad will the real estate market get. It plays a huge role in the economy when you think about it, construction jobs, the value that individuals extract from their homes that have increased in value, how it supports the consumer, which is about 70% of the economy. That's why there's so much focus on the real estate market right now. It's played a huge role in keeping the economy going these past several years. The media has covered this pretty aggressively. We get a lot of criticism from people who think that our stories are trying to bang the real estate market down. And it's an interesting thing to get this criticism. And it reminds me a little bit of the internet era when a lot of the business media was criticized for not being critical. And so perhaps some of the business media are trying to pay penance for the criticisms they received in that era. One of the challenges of covering this story with real estate, the big boom, is that there's a lot of national discussion, but it's really a highly local and regional market. What happens in Manhattan, where they're not building a whole lot more of that island, is different from what happens, say, in the Twin Cities, Minneapolis and St. Paul, where they're spreading out into Wisconsin. And so it's very difficult to capture all of these different markets in a single national theme. So one of the challenges is to try to capture where things are particularly intense, where they're not. And it's not just one monolithic picture. In terms of the financial markets, we've seen a lot of things you'd expect. Timber, for instance, was a very hot place to be as an investment up until recently, but timber prices have fallen dramatically in the last several months. Home building stocks have also predictably fallen a great deal as the housing slowdown has become more prevalent. But what's interesting is a few of the rumblings of change you're starting to see. The financial markets are a forward predictor, usually thinking 6 months to 12 months ahead. In the last few weeks, the home building stocks have started to rebound, putting in some good gains. I was also at a private equity conference last week, where one of the hot topics was a lot of the private equity firms are talking about maybe it's time to look at buying some of the home building stocks. So you see kind of the makings of at least some people thinking that there's a bottom in the stocks that represent the housing market, which could mean that maybe the housing bust won't be as bad, or these smart private equity people could of course be totally wrong, in which case it will get worse. You like that? There's a commitment, huh? It turns out real estate is very important, as I said, to the markets, the economy, and if you pick up the Wall Street Journal on Monday, I'll give you a quick preview. We're doing a whole section on real estate. Covering the real estate markets, we're analyzing home building stocks, we're looking at what's happening in the mortgage market, looking at the construction industry, home building stocks, trying to really put it all in perspective. It's risen up to that level in terms of its role in the marketplace that deserves a large and devoted amount of coverage. So, without further ado, we'll get on to our two panelists. Chris Thornburg is going to talk to us about the macro picture in the housing market. He has, I believe, a presentation. Chris? Thank you.
Okay, am I on here? Morning. So, let me see, how do I put this? Yes, there is a bubble. Yes, it is popping. Yes, it's going to be ugly. Thank you. Now I'll fill in the rest of that. I'm going to talk today a little bit about the national picture, and then I'm going to spend a little bit of time talking about the local markets. Absolutely right. Different markets do different things at different points. The U.S. is not monolithic. There's lots of different kinds of economies. I am actually based in California. I was sort of surprised when Jonathan invited me here today. But I suppose if there's any place to study real estate booms and real estate crashes, California is a great place to cut your teeth. And Jonathan asked me to come up here and talk a little bit about the national picture and talk a little bit about what's been happening here in the local region, which is what I'm going to do today. Now, when you talk about economic forecasting, because technically speaking, I'm an economic forecaster, I can tell you right now that forecasts are always wrong. That's the first rule of forecasting. A good forecaster is less wrong than a bad forecaster, okay? Looking into the future is at best a murky business, but we do the best we can. The other thing about forecasting you got to realize is that when you're looking towards the future, there's two things you're looking for. What I call the trends and the bends. The trends are those long-run growth patterns that drive an economy forward. That's policy issues having to do with everything from zoning to tax laws to immigration policy and so on and so forth. The bends, on the other hand, are those temporary slowdowns in the economy, those things we call recessions or mid-cycle slowdowns, or whatever you want to term them, which are kind of really, each one's a unique event in its own right. They're short-run slowdowns caused by some sort of shock to the economy. But think about the bends, because they're dramatic, they capture headlines, but economies do recover from bends. The bends work themselves out of the system in the long run. For every bend, there's a nice growth spread on the back end of that. But of course, during the bend, it's quite painful, particularly for those people who are most impacted by it. Right now, the trends, the U.S. economy, labor market's doing okay, not great. In fact, we got a report this morning that was pretty poor. Income growth has been fairly decent, a little bit stronger. Population growth has been strong, particularly in this part of the world. On the other hand, while a lot of those trends are decent, the bends look quite severe, and that is, of course, boils down to real estate, and real estate. Real estate is an enormous driver of the economy. It has been an enormous driver of the economy over the last couple of years. But unfortunately, the kind of growth we've seen in the real estate markets is clearly unsustainable, and it's going to come to an end, or more specifically, it has come to an end. I will tell you right now, here's a little preface about the rest of this talk. We're in the middle of what I would call a slow-motion train wreck. Real estate bubbles, when they crash, do so very slowly. The entire process from beginning to end takes a year to a year and a half. We're approximately in the middle of that. We've come nowhere near the bottom of this. And when we do hit bottom, we'll know the full extent of the damage to the economy. Now, what I do want to start out with some vacation pictures, because why not, right? I managed to spend about 3 weeks in South America during September, kind of escape from everything. And it was amazing how the world can change in 3 weeks. When I left, it was summer. When I came back, it was fall. When I left, these pants fit well. When I came back, they were a little tight. When I left, the economy was in shambles. All the news, all the newspapers talked about how things were slowing down and all the bad news. And when I came back, everything was rosy. I'm hearing about stock markets hitting all-time high. Even housing builder stocks are starting to bounce back, and everything was wonderful. And I was thinking, what happened? What could have possibly changed everybody's mind in the last 3 weeks? Well, you know, we had this so-called slowdown in GDP. But really, when you sit back and look at the slowdown in GDP, especially with the upward revision for those second quarter numbers, slowdown isn't so bad. Second quarter, the economy grew at about 3%. That's basically a minute amount less than average growth, which is about 3.1%. Certainly not the torrid rate over the last couple of years, but I would hardly call that a bad number. And a lot of the fundamentals were decent. In those numbers. Income growth remains relatively steady. Non-farm employment growth, not so good, but you know, economists tend to look more at unemployment than employment. We find that unemployment is a better sort of indicator of how well those labor markets are doing. And we all know unemployment locally, unemployment nationally, really at a very low level. There's not a lot of people looking for jobs right now, indicating underlying stability. Of course, the big thing that happened over those 3 weeks was oil prices. Oil prices started coming down, and also with that all the commodity prices, copper prices, timber prices, all these commodities that were not only putting inflationary pressure on the economy, but were also squeezing various sorts of parts of the economy by raising their inputs prices up. Well, all those commodity prices started going down, relieving some of the pressure on the economy. And of course, in the midst of all that, the Fed, which had been worried about inflation, all the signs that the Fed was going to continue to tighten and drive up those rates, well, the Fed pulled back. For 2 times in a row, the Fed did not tighten at all. They said, we're not so worried about inflation, we're a little bit worried about the housing market. And of course, what that's done is it's basically stopped those short-run interest rates from going up. And that's also helped the economy, making capital a little bit cheaper. And here's some of those numbers. Again, core inflation, you can see core inflation starting to slow down. We were up at a pretty high pace, but already coming back. And of course, those 10-year bond rates, that long-run debt, still remains remarkably cheap. We're still a capital flush nation. All good signs, right? We're out of the woods. And again, this is some of the happy headlines I heard when I got back. S&P hits 5-year high. Oil prices to 6-month low. I mean, U.S. economy follows Fed's script for slowdown. I love this. Turns out this whole thing is planned out, folks. Beginning there. Even news that might have been bad. We had a military coup in Southeast Asia. We all know how that can be sensitive and reverberate over the world, but nothing. Not a blip. It was a happy coup. It was a good coup, okay? Nothing, even Brad and Angelina are getting along great. The world is a wonderful place. It's a wonderful place. But is it? Is it really wonderful? Well, not quite. Because you know what? When I left, there were a lot of problems in the U.S. economy. And when I came back, all those problems are still there. As a forecaster, I have to think 6 months to a couple years ahead. Most of the news reports think in the next 2 months or next month. It's kind of almost what I would call a dog mentality. You know, when you leave home, your dog thinks you're gone forever and never see you again. It's the saddest day in the world. You come home, you're home forever. It's the happiest minute in the world, right? And this kind of goes up and down like that. But I kind of have to keep a longer run perspective on the economy and think about the bigger issues, the bigger kind of imbalances. So right off the bat, I can tell you, gas prices are not that big of a deal. Now, that may sound surprising to you, but you know, when you look back in time, you go back, let's take oil prices. Let's inflation adjust oil prices. Well, inflation adjusted back in 1980, oil prices were $100 a barrel. At their peak, they only hit about $70 a barrel. So we never had the kind of oil crunch that we had back in 1980. Not only that, but we are much richer as a nation than we were back in 1980. And we as a nation, oil isn't as important because we're an economy that's much more dominated by services. Oil was never that big of an issue. Now, if oil prices had hit $120, $130 a barrel, we could have had a talk. But it never got close to that. And while gas prices did get up to about 18% of hourly earnings just kind of gives you a gauge of the impact of gas prices on sort of the blue-collar economy. Well, okay, 18% back then in 1980, it was like 19%. That's pretty close. Well, okay, but bear in mind, in 1980, that gallon of gas got you about 14 miles. Today, it gets you 25 in a much better car. So we were never a transport-constrained nation. This was never really that big of a deal. Now, what this means, of course, is on the way up, not that big of a deal. On the way down, not that big of a deal. Don't get too excited about falling oil prices. GDP fundamentals, still out of whack. Lots of growth. Where is the growth been coming from? One of the largest sources of growth has been residential investment. We are now spending as a nation, as a percent of our economy, more than we ever have, building new homes and fixing up existing ones. And as I'm going to show you, at an unsustainable rate. This has to go back to a more normal level. The return of residential spending back to a normal level, all by itself, can shave 1% to 1.5% off growth for the next 2 years. Bam, that's half of average growth right there. Before we talk about anything else. Net trade, we still have this massive trade deficit. 6% of GDP, clearly unsustainable. Clearly something has to change there. Now, what is a trade deficit? The administration wants to tell you it's all about the Chinese. They're keeping the yuan too low, it's all their fault. That's ridiculous. It's absolutely ridiculous. What a trade deficit is the gap between what a nation produces and what it consumes. We as a nation are consuming 6% more than we're producing, period. We are on a spending binge. As I'll show you, it's a public spending binge, it's a private spending binge. Well, we are on a spending binge. And we are borrowing from the rest of the world to go on this spending binge. To blame the Chinese for this because of the value of their currency is like me walking into Walmart and going, hey, you gotta raise your prices because I can't control my spending. Think about it. That's exactly what they're saying. It doesn't follow. It just doesn't follow. The thing that really worries me, consumer fundamentals. Over the last year and a half, for the first time since the Great Depression, private savings, which had already been at an abysmally low rate, dropped into negative territory. Over the last year and a half, people are spending more than their disposable income. Clearly unsustainable. Clearly, consumers have to pull back. They have to go back into saving mode. They have to spend less than their disposable income. Now this number here, all the time you'll hear consumers drive the economy, consumers drive the economy. That's absolutely true. With the exception of 2001, every recession since World War II has been led by a decline in consumer spending. So we don't want to see consumer spending decline rapidly. That's bad news for the economy. Nonetheless, consumer spending has to remain in some sort of sustainable level. It can't be sustained at this level. It has to return to some degree of normalcy. And debt payments as a percent of personal income, disposable personal income, at an all-time high despite low interest rates. This is not a healthy economy. This is an economy with a lot of problems. So what's been driving all this wonderful spending? Well, part of it is the stock market that's been pumping a little bit of wealth. And of course, stock market's pretty imbalanced. There's a small group of people in the U.S. who own the vast majority of the stock market. What's really driving most of the consumption across the U.S. right now is housing prices. That wonderful sense of new wealth that's been filling up people's pockets. This picture here is kind of a long review of housing markets. The yellow line is employment, it's year-on-year change in employment. The blue line is year-on-year change in housing prices. Two things that immediately get out of this picture. The first thing is that, for the most part, housing prices move with employment. When we're adding lots of jobs, housing prices are going up. When we're losing jobs, housing prices are going down. Second thing to get from this is, guess what? Housing prices do go down. Now, every time I pick up something that the National Association of Realtors writes, they will tell you that housing prices in the U.S. have never fallen. Well, if you forget this little thing called inflation, okay, they've never gone down. But it's kind of important to take into account inflation. Why? Because when your grandfather starts telling you, when I was a kid, a beer cost a nickel and a burger cost a dime. And yeah, but you made 20 cents an hour. All right, this is not, you got to keep in mind that prices change over time. And to look at housing prices without looking at inflation is, well, useless for all intents and purposes. There have been plenty of times over the last 50, 60, 70 years where housing prices have indeed fallen. Here's a little quiz. What's the average increase in housing prices in the U.S. economy in real terms? Average annual increase in housing prices. I'll pick on my fellow speakers. What do you guys think? A little less than 1%. About 0.3% per year on average in the long run. Doesn't mean housing's a bad investment, mind you. Housing is a very good investment. But it's not an investment that pays you back through appreciation of the underlying stock. It's a blue chip investment. It's an old school investment. The return on a house is the dividend. The fact that you get to live in it or rent it out to somebody else. That's the return on a house, not the appreciation of the asset. But of course, you haven't seen that in the U.S. economy over the last couple of years. In fact, we had a very strange cycle in 2001. It was an adjustment completely on the business side of the economy. And the housing market and the consumer market never cooled off. We saw housing prices continue to rise even as employment dropped off. And then, of course, when jobs did come back, the housing market went nuts. And the national level we saw price appreciation through 2004, 2005 of something on the order of 10% per year. 20 times the average annual amount. Quite astonishing. Not only have we seen that rapid price increase, but we also see an overbuilding like we've never seen before. In 2005, this nation built 2.5 new units for every new household. Think about that for a second. 2.5 new units for every new household. Absolutely an unsustainable number. Absolutely something that is going to have to crash. It's going to have to slow down dramatically. So what is a bubble? Why do we have all this incredible run in prices? Why do we have this incredible run in building? What all boils down, of course, to, well, I already mentioned it, a house does have a fundamental value. Now, right off the bat, when you talk about bubbles, forget prices going up and prices going down. There's lots of time when the price of an asset will go up and go down again. Remember what an asset is. It's something that gives you a store of value in the future. If I buy a stock, it's the dividends I'm going to get in the future. If I buy a bond, it's the coupons I'm going to get in the future. If it's a house, it's the rental value that I get into the future. Now, if your future expectations legitimately go up and then go down again, prices today of that asset will go up and down again. A pharmaceutical company comes out with a report. We've discovered a drug that when you take it, it takes 10 years off your age, gives you six-pack abs, makes your IQ go up by 10 points, and allows you to run 26 miles. What's going to happen to their stock price? It's going to go whoosh, way up. Why? Well, for obvious reasons, because this is a great product, they're going to sell tons of it, and they're going to make lots of money in the future. Then a month later, they report, well, we've done some tests, there's a little side effect. When you take this pill, your arms and legs fall off. Stock price, back down again. Absolutely legitimately. So up and down prices is not a bubble. What is a bubble? Well, an asset has a fundamental price. When the fundamental price becomes completely disassociated with the market price, that's when we have a bubble. It's that complete disconnect. It's that complete. Amazon.com at $200 a share. You know, there was a great economist at UCLA sat down and did a little study. He said, look, what if Amazon.com had captured 100% of the book market, 100% of the DVD market, 100% of the CD market? Would they ever have made enough profits to justify that market capitalization? The answer was absolutely not. So why was it worth that much? It's a greater fool theory. I'm buying it because somebody will buy it for more. It's basically expectations of appreciation driving appreciation. And that's exactly what happened in the housing market. In the late 90s, we saw a rapid run-up in rental prices. That legitimately drove housing prices up. And then, of course, when that cooled off, those mortgage rates fell. Remember, mortgage rates being low are not good for a homeowner, and being high are bad for a homeowner. Because when mortgage rates fall, the discount rate on those future rents fall, and the price goes up. You as a buyer, well, low mortgage rates, higher price. Vice versa, mortgage rates go up, price comes down. You as a buyer, higher rates, lower price. So you don't get too excited about that. But anyway, those mortgage rates drove prices right through 2003. Beginning of 2003, rental prices were still flat, building like mad, no sign of major rent increases in the future, and of course, mortgage rates had nowhere to go but up. At that point in time, the market should have cooled. It didn't cool. It went haywire. And that's because between 2001 and 2003, price growth was strong. People, they think in terms of trends, they don't think in terms of fundamentals. If they're good in 2003, they're going to be doing good in 2004. I got to get me some of that free money. They rush into the market, prices go up, causing more people to want free money, rush into the market, causing prices to go up. And it feeds on itself, and it feeds on itself until when? Until the pyramid becomes so large and so unstable that it can go do nothing but collapse. So this was a self-fulfilling. This was going to happen. It was never a doubt when the bubble was going to burst. It was only a matter of, never if it was going to burst. It was only a matter of when. Now the when, of course, a little quiz first, okay? Now let's think about the economy over the last couple of years. An economy driven by consumer spending, excess consumer spending driven by real estate wealth created by a bubble that was stimulated by rapidly falling interest rates caused by you-know-who, Mr. Greenspan. So the quiz for this morning, this guy on the right here, of course, he used to be a home run hitter for the Giants, not this year. On the left-hand side, Mr. Greenspan, what do these two guys have in common? Well, of course, neither will admit that they did anything wrong in order to artificially boost performance. So, that bubble thing. How do you know bubbles end? Well, it starts in the activity side. Then it spills over into everything else. Activity, of course, started ending in the late 2005, and of course, close behind that, housing starts to fall, new housing sales and so on. Within 6 to 9 months after starts and permits and activity start to fall, prices top out, and prices topped out right about now. In 6 to 9 months from now, that's when consumers finally realize their house is no longer going to pay for their retirement, their kids' college education, and therefore they can't spend as much as they have. So again, we're in the middle of this slow run train wreck. Are non-residential going to pick up the slack? Nope, it's not big enough. Good news, of course, housing, not that huge a component of the economy. The dollar's down, exports are up. Corporations are sitting on large war chests, cyclical employment limited by a lack of buildup. So overall, there are some strong signs that can support the housing market, but no matter how you add it up, over the next couple of years, it's going to be a weak economy. There's going to be a lot of energy drained out of that. The big wild card here, wealth effects. People were generating something on the order of $9,000 per year in the US in terms of additional wealth. That's 25% of income. What happens when that goes to zero? Take money out of people's pockets, you have the potential for a consumer shock, and that's what we're waiting for right now. Now let me bring it a little closer. What about this region? How are things here? We know population growth has been relatively strong. Well, kind of strong. Certainly in Colorado and Idaho, things have been booming. Not so much in Wyoming and Montana. You look at price trends, and I'm comparing this to California because it's a great thing to compare. You can see California, the enormous run-up, the enormous appreciation through 04, 05, the big collapse. You can see Idaho also late, but had a big run-up in prices. It's also starting to turn. Montana and Wyoming also got into the game a little bit late. They're still flat, but at way too high of a pace. And of course, Colorado, completely different trend. Colorado got whacked, and when the dot-com collapsed. And of course, so they're on a completely different trend than the rest of the place. So how stable are markets around here? What can we look for? Well, here's some basic numbers. I'm just going to run through these real quick. First of all, at the top, that's the number of permits over the last 5 years and amount of new population. You can see the ratio of new people to new homes, about 1.4 in Colorado, 1.86 in Idaho, so on and so forth. All those numbers are considerably lower than the average household size. That means pace of building here, faster than really you might expect. Now you got to keep in mind that household size are falling because of more retirees and that kind of thing. So to some extent that can absorb some of that excess population. So what I threw in there is some numbers on vacancies. And again, with the exception of Colorado, Idaho, Montana, Wyoming, vacancies really haven't increased over the last 3 years. That's good news. That means the markets here are relatively stable. Colorado, completely different picture. Completely different picture. Of a doubling in vacancies, real vacancies. Now this is for rent and sale. This is not vacation homes. Doubling in for rent and for sale homes over the last year. Colorado housing markets definitely due for a big collapse, but the rest of the area so far has been pretty good. Looking at median housing prices to incomes, they're, well, okay, prices have gone up a little bit relative to incomes, but nothing like, of course, what we're seeing in California right now. In California, we're talking about a median housing price to median income of a ratio of about 10 to 11. That's really unstable. Around here, things aren't so bad. They really aren't so bad. So overall, this looks decent. It looks decent. It doesn't look like there's a lot of instability with the exception of Colorado. Now, one other thing to throw in, of course, is jobs. Job growth, particularly in Idaho and Montana, over the last couple of years have in fact been driven largely by construction. Construction jobs have made up about 20% of Idaho jobs, Montana about 25%. That is more of an issue. That is more of an issue because this may not have an impact. Housing markets may not be completely imbalanced, but I can also tell you, you're going to see some sort of slowdown, and that will have a secondary job impact. And home building is slowing across the region. You can see permits falling pretty dramatically, with the exception of Montana, still positive on the single family, although falling rapidly on the multifamily. So if I had to add up, talk about sum up on regional housing, again, it's stable, there's no doubt about it, with the exception of Colorado. Things are mostly stable. On the other hand, the current pace of appreciation in home building cannot last. You will see things start to slow. Just as things kind of caught up in the rest of the rest of the economy a little bit slower, they'll slow down a little bit slower too. Luckily, because the bubble wasn't so big, it won't have a dramatic impact. There are some risks here. Obviously, with commodity prices falling, Montana, Wyoming, with the large commodity sectors, can take a hit on that count. You got to watch out for that. Second home market, that's pretty big. A lot of people are buying second homes because they feel they're so rich. That's going to cool off too, don't forget, because those people aren't going to be so rich anymore in a couple of years. U.S. economic turmoil will spill over. This is going to have an impact on the U.S. economy. Will it cause a recession in 2007? That remains to be seen. I give it about a 1/3 chance next year. It's that ugly right now. But no matter what happens, it's going to slow down, and that's going to have some spillover. And of course, as I already mentioned, those construction jobs. So wrapping up, the U.S. positive, inflation forces are moderating, the Fed's going to continue to hold back, employment's back on track, consumer spending okay for now, it's on track, but it can't last. The negatives, fundamentals still out of whack. We have to have some return to normalcy. The real estate bubble continues to pop, no sign of the bottom yet. We have not come close to the bottom. That won't happen 6 months from now. And of course, last but not least, the 2007 outlook, Rick's really shaky. I got to wrap up, of course, talking a little bit about California. when you boil this down from my state's point of view, you've probably been hearing about some of those budget problems that we have. Well, if I had to summarize everything, Schwarzenegger's probably going to get re-election. He's hoping for an economy like this to get him out of trouble, but he's going to get an economy like that. Thank you very much.
While we're waiting for the computer to switch over, I'll ask Chris a quick question. The word bubble brings to mind Japan stock market, which is still way below its highs reached in the late 80s. The NASDAQ, which is still 1/2 the level it was from its highs. Is that the kind of scenario where real estate values could fall that dramatically and stay that down over a long, extended period of time, or are you talking about something different?
Yeah, actually, I meant to bring that up in my presentation, but I was getting scared by the number signs that kept popping up here in front of me going, countdown! Housing prices tend not to collapse unless you lose a lot of jobs in the local economy. So, at the worst, I would say that the U.S. is due for housing prices maybe falling 3-4% a year in real terms over the next few years. Maybe not at all, the economy stabilized. Now, that doesn't mean we're out of the woods. It doesn't mean that your house isn't overvalued. Here, not so much as some other places. What it does mean, this is why I tell people, if you're in a severely overvalued market, such as California, such as New York, such as, say, the Twin Cities, basically the price of your house today is going to be the price of your house in 2012. So there's two ways that overvaluation can work its way out of a housing market. That is to say, prices fall to where they should be, and then they start rising again, or they go flat until the fundamentals catch up. One way or the other, those two things have to converge. And that means, of course, that yes, housing markets are going to be weak for a while. Now, the interesting thing is if you're in the real estate market in one of these overvalued markets, is the better off the rest of the economy is, the worse off you are. Because what happens in these kind of markets, the reason prices don't fall, is because the response to a bubble collapsing in the real estate market is completely different than in the stock market. The stock market, lots of liquidity. And of course, when that housing market, when that bubble collapses, you see prices fall rapidly. It commits a massive amount of buy, sell, buy, sell, buy, sell. But housing markets are different. Housing markets are not that way. The worst thing in the world is having to face the fact that if I move, I have to clean out my garage. All right? When you think about that, what happens is people go into bunker mentality, and liquidity collapses in the midst of that. Liquidity collapses, not price, liquidity. And you see housing markets with 1/3 the amount of transactions going on even 2 years previously. The real estate industry takes a big hit, but prices just can't fall. People are loath to sort of recognize that kind of issue. I think I took just enough time.
Well done. All right. Jonathan?
Good morning, and thank you for having me. Thank you, in particular, Jonathan, wherever you are, for inviting me. When Jonathan invited me to come and give this talk, he'd heard a presentation that I'd given, a variation on this, and when I asked him what he was looking for, he said, basically, you've got two challenges. One is take your 60-minute presentation and cram it into 20 minutes, and the other is that the audience was going to be large and very diverse. He said there were going to be real estate development people, there were going to be government officials and policymakers, there were going to be folks from the nonprofit sector. So the question for me was, it comes down to managing expectations, the equation for life being satisfaction equals reality minus expectations. So the question was, how was I going to be able to peg expectations for you guys so that you'd come out of this feeling like you had a good presentation from me? Before I go any further, I'd also like to give a shout out. My organization, the Chartour Institute, we're based in Jackson Hole, and we study growth and change in resort communities and national park gateway communities. Part of the reason that I'm here today is to try and give you a sense, using those as a metaphor for growth and change in the Northern Rockies. One of my board members you'll be hearing from later, a fellow named Steve Doerr, so I just, for political reasons if nothing else, I wanted to acknowledge my board vice president. But in any event, so managing expectations, how can I make sure that you come out of this with a good experience? And I was agonizing over this. One of my jobs in Jackson is I write a column every other week for one of the two weeklies in Jackson, the Jackson Hole News and Guide, and it's sort of the paper of record. We also have an alternative weekly, and they gave me a gift a couple of days ago in their Wednesday edition, a column called The Redneck Perspective, The comment in particular was, has anyone ever been able to finish one of Jonathan Schechter's columns? And the key question was, how does it help me get chicks? And so in terms of your expectations, I'm going to try to avoid being boring, but I can't help you score chicks or studs. So with that, hopefully we've pegged the level of expectation on this presentation, and we'll take it from there. As a point of departure for what I'd like to talk about, and I'm going to talk more about growth and change in general and less so on real estate, but I'd like to start with talking a little bit about real estate. And here's a piece of data which is kind of interesting. If you look at the median home price in the United States in 1990, it was $79,100. In the next 10 years, during the course of the 1990s, it grew by $40,500. The reason, if you multiply it by 4, you're at 162,000. The reason that's important is that we have a little bit of a technical problem, but there were 10 counties in America during the 1990s where home prices grew by $162,000 or more. 9 of them, one was Manhattan, the island of Manhattan. The other 9 were resort communities, and as you can tell, with the exception of Nantucket, 8 of those 9 were here in the Northern Rockies. These were the fastest growing counties in terms of median home prices in the United States. Out of 3,140 counties, these were 9 of the top 10. And these are what I've come to call the A9, or the archetypal 9. And I realize that many of you don't live in pure resort communities, or these counties in particular. But what I'd like to offer up to you is to think about these communities as metaphors for your community, because basically what ties these together is quality of life issues. These are lifestyle communities. I will argue to you that you probably think of them as tourism communities, but they've become lifestyle communities. And to the extent that our region is growing, I would argue to you that it has a lot to do with lifestyle, quality of life issues. And so I'm going to walk you through a little bit of information about how the A9 are changing and growing, and what that means, and what some of the implications are. So I'd ask you to keep in mind as I run through these slides, what does this really mean for my community? To put this all in a little bit of context, here's the world's population since the birth of Christ, 2,000 years ago. And what's interesting to note is that basically the world did not grow for about 1,500 years, and by 1900 there were about 1.5 billion people. And during the course of the 20th century, the world's population more or less quadrupled to something over 6 billion people. And so this slide here shows, so we had about 4 billion people or so, 4.5 billion people added to the world's population during the 1990s. If you look at the A9, basically, this is a weak laser pointer, and I've only got one screen to point on, but the thing to take away from this graph is that the A9 communities were very, very immune from what was going on in the rest of the world and the rest of the nation during the 1900s. Basically, their population in 1970 was about where it was in 1900. And then during the last 30 years, things really took off. And I would break this into 4 general periods of growth and evolution for these communities. Until about 1960, they were in the ag and mining period, where there wasn't really a whole lot going on. And the reflection of that economic situation was that their populations were flat. These are, again, Jackson Hole, Aspen, Sun Valley. These places, their populations did not grow between 1900 and 1960. During the 1960s, the period I call industrial tourism, that's when the downhill ski industry really got going. Obviously, Nantucket doesn't have much of a downhill ski industry, but for the other 8 counties, this is when it really started taking off. And you see a big population boom between the periods 1960 and 1980. 1980 to 1990, things started to slow down. I'll talk about a transition era. And then finally, in the 90s, things started booming again. In fact, in the 1990s, these 9 counties added more people alone than they did during the previous 90 years. If you look at relative growth, in both the United States and the world, the populations roughly quadrupled during the 1900s. If you look at the A9 communities, during the last 30 years, they've been growing at a much more rapid rate than our rapidly growing world and our rapidly growing nation. As with population, so goes housing. The orange line that you see on this screen is the number of housing units in this community, in these communities. And this, I'm going to do a little bit of myth busting in the course of this talk. And one thing I'd like to draw your attention to is that these two lines pretty much parallel each other until the 1990s. And you can see that the black line grows a lot faster than the orange line during the 1990s. In other words, population is growing a lot faster than the housing stock. Well, what's going on? Well, myth buster number one, these homes are much less reliant on, or these communities are much less reliant on second homes today than they were before. The blue bars in this graph are the number of second homes, and as you can see, by the 1990 census, the number of primary occupancy homes and the number of second homes had equaled in these communities. Go back to 1950, and the red dot in this graph, that's the proportion of primary occupancy homes. So what you saw during the course between 50 to 90 was a slow decline in the number of primary occupancy homes to a point where by 1990, you had a roughly equal number of second homes and primary homes. But during the 1990s, something very strange happened. The number of primary homes shot up dramatically. The number of second homes didn't grow much at all. What happened? That's how these populations can grow a lot faster than their housing stock. What's basically happened is that the second homes in these communities are being converted into primary occupancy homes. People have a greater and greater freedom to live wherever they want to live, and they are taking what used to be vacation homes and turning them into primary occupancy homes in places where they want to live. Places where they used to take vacations, now they're moving there permanently. Why? Because they want to, and they can. It's a supply and demand issue, and with supply and demand being out of imbalance as it was in the 1990s, we saw a dramatic increase. I took account in inflation and anticipating my colleagues' talk. These are constant dollar values, median values of the A9 counties' homes from 1950 on. And as you can see, during the agriculture and tourism era, or the slow agriculture era, home prices really didn't grow. They took a huge spurt between 70 and 80 when second homes were really going. These places were going nuts with their tourism economies, especially skiing. And then in what I was calling the transition era between 80 and 90, the median home price on a constant dollar basis actually lost 1% in these 9 counties. Real estate in Jackson Hole, real estate in Aspen, real estate in Sun Valley was in the doldrums. Last night I was talking to the mayor of Bozeman. He was talking about what the doldrums period of the 80s were in his city. And then in the 1990s, the median home value more than doubled on a constant dollar basis. Something happened between the 80s and the 90s, and that is, I would argue, affecting all of your communities, affecting all of us here in the Northern Rockies. Again, an emphasis on lifestyle, and one of the consequences is that it's driving home prices. So if you're having a problem with lack of affordable housing and housing prices going out of control, then there's a reason for it, and you're not alone in that. With a couple of other indicators of things that have changed in these communities during the last 30 or 40 years. If you go back to the 50s and 60s, very few people in America had a college degree. It was the same was true in the A9. If you look at us today, about half of the adults living in the A9 communities have a college degree or better. This is about twice as the ratio of the United States as a whole. It's also changed the politics. In this graph, the red dots show the number of counties won by the Republican presidential candidate in each of the presidential elections since 1960. The blue dots show the number of counties won by the Democrat. As you can see, with the exception of 1964, when Lyndon Johnson polled a greater proportion of votes than any other candidate or presidential candidate in American history, the A9 candidates, or the A9 counties, were solidly Republican bastions. It all shifted between 1988 and 1992, and since then they've been these Democratic strongholds. Things have changed, and the theme that I hope you're taking away from a lot of this is that between the 80s and the 90s, something very fundamentally shifted in these communities, politically, educationally, housing prices, population. Something very strange and interesting is going on in these communities, and the question is what? And I would argue to you that there are basically 6 forces that are driving change. The first of them is change in technology. And if you think about it, I'm going to have to hang on. The first of these 6 major changes is changes in technology. If you go back to 1980, there was no fax, there was no FedEx, no PCs, no telecommunications changes. By 1990, we were taking that stuff for granted. In 1990, there was no World Wide Web. There were no cell phones, DVDs, and the like. By 2000, we were taking that for granted. Today, in just the last 5 years, a lot of technology has been introduced into the world that we are taking for granted. And so the first thing that's really driving a lot of these changes in the A9 and again in the Northern Rockies is that there's an awful lot going on in the world in terms of technology that we are not immune from and that we are embracing just as fast as anybody else. The second basic change is in the economy. And I want to go back to the second myth that I'd like to bust along with second homes. And that is, these resort communities are no longer tourism-driven communities. Tourism is important, but it's no longer the engine driving growth. And what this graph is showing is the growth in skier days in the 8 counties that have major ski areas. And as you can see, from the late 70s until the early 90s, there was a pretty healthy growth annually in skier days. A couple of years there was bad snow, but for the most part, things grew. And then since the 1990s, early 1990s, things have been very flat. And the question, and then you can take this another step further, and that green line is the number, if you assume that everybody who's living in these communities is skiing a couple days a year, that green line is the growth in residential skier days. And if you back out the residential skier days from the total skier days, you get destination skier days. And here's the paradox facing a lot of these tourism communities. Basically, destination skier days have been flat for well over a decade now. But during that same period of time, population has grown much more rapidly than in the US as a whole. Housing prices have gone much more rapidly. Per capita income, a lot of different measures have all grown much more rapidly. The same thing is true with visitors to national parks. The national park visitation is way down. If you were involved in the tourism industry and you depend on people visiting Yellowstone National Park or Glacier National Park, it's a declining market. People are moving to these communities because national parks become amenities for them. And what's going on here, and I'd like to take another slight detour and talk about 4 phases of economic activity and evolution. And just to put it simply, there are 4 phases. Any economy will go through 4 phases of an evolution. The first phase will be hunter-gatherer, Native Americans who were living around here 150 years ago. Second phase is going to be agriculture and mining, basic extractive industries, land use. Third generation will be value added. This is taking manufacturing in places where there's transportation available, in places where transportation is not available, but there's great scenery, it becomes a tourism economy. Eventually that evolves into value-added intellectual activities in investing. And the reason this is important is because I want to show you what's been going on. These 3 lines, the blue line shows, or the purple line shows third generation. Essentially, this is the decline of the manufacturing sector. If you follow that purplish blue line down, that's what happened to the manufacturing sector in the last generation in the United States. The black bar is investments, and the green bar is a combination of agriculture and government. This is what's been going on in the United States over the last 30 years. And if you notice, it goes from divergence to convergence. Here's what's been going on in the A9 during that same period. It's going from convergence to divergence. In the late 60s, early 70s, when the old timers who are still in your communities were there, when agriculture and tourism were really dominating the industries of our Northern Rockies region, basically investments, tourism, construction, and agriculture all accounted for about the same proportion of our income. Today, in the A9 and in the Northern Rockies in general, investments count for about as much as tourism and agriculture combined. And if you break that into its constituent parts, you can see that actually construction, at least in the A9 communities, accounts for more income than lodging, accounts for more income than agriculture and tourism. There's a fundamental shift that's gone on in these communities in the last 35 years to where people who have 4th generation incomes, who can really live anywhere they want to because they have the flexibility of investments, they are choosing to move to our communities. Why? Because there's something about them that speaks to their heart. It's a passion thing, it's love, they go there and they say, Eureka, I can live anywhere I want, this is where I want to be. That's the fundamental dynamic affecting our region right now. Third basic change is transportation. The black line that seems relatively flat along the bottom, that's population growth. and that's basically doubled in the United States in the last 40 years. The pinkish line above it, that's the number of cars. If you're worried why transportation is much more difficult than it was a generation or so ago, it's because right now in America, there's about 1 car for every person over age 16. 40 years ago, there was about half a car for every person over age 16. Car growth has paled in comparison to airline transportation growth, and that brown line at the top, that's FedEx, that's UPS, that's next day delivery. It's why the fish I had last night was sitting in Alaska waters 2 days ago. It's why you can get your book from Amazon. What that's allowing is that anywhere you live, you can go ahead and do anything you want anywhere because you can get consumer goods. Fourth basic change is in Maury. We want it all, we deserve it all. Casual dress, I see only 1 or 2 people here who are wearing a tie. I managed to shame my fellow panelists into taking their ties off. We want the best, we want it for nothing. Fifth basic change is in value. What the A9 have, what your communities have, what we have, are things that are increasingly in scarce availability in larger metropolitan areas. And the final thing is the change in the quality of urban life. And as cities become more and more congested, what we're seeing is essentially a virtual suburbanization. The A9 communities have become virtual suburbs. People who are living in San Francisco can move to Jackson Hole. People living in New York, people living in LA, they can all move to Jackson Hole and continue their big city jobs. And it's the same sort of general dynamic that drove the suburbanization of major cities in the 1960s, following the Second World War. People are moving to where they want to because they can. And that's the basic dynamic that's affecting growth and change in the Northern Rockies. So what's happened to it? Basically, economic evolution is accelerating. Over the last, it took 90 years to go from a second generation to a third generation economy. It took 10 years to go from a third generation to fourth generation. We are lifestyle economy towns. One of the problems is that we still view ourselves as a tourism kind of orientation or an agriculture or mining kind of orientation. That's a real problem. The pace of change is going so much faster than we as humans can really appreciate it, and it's going infinitely faster than our institutions, particularly government, can deal with it. So if you're wrestling, whether as a business leader, a community leader, an elected leader, with the pace of change and you're trying to struggle with it, there's some very good underlying reasons for that. What does the future hold? These changes are not going to slow down. Technology isn't going to reverse itself. Economy isn't going to move back to second and third generation. Transportation is not going to become any less important and the same. We're going to continue to face the same challenges, even more so. Another big pressure on us is we're going to get more and more homogenized as everything from economic pressures to the fact that you can get a piece of fresh Alaskan halibut here in the middle of the Rocky Mountains. That's a huge deal and it's not going to go back. A couple of no-brainers. Everything is going to continue to get more and more important. Unlike previous booms, this one isn't going to bust because it's a lifestyle-driven type of thing, and it's a much more fluid type of thing. We're much more dependent on national and international economy than we are commodity prices. We are not only becoming virtual suburbs of major big cities, but we're also creating our own suburbs. In Jackson Hole, we've created suburbs. South of us in Star Valley, we've created a suburb in the Teton Valley. And that's only going, anywhere there's private land near any of your places, it's only going to become suburbs of these larger cities. I got the end sign. I will give you some conclusions. Basically, economics, I would like to leave you with one maxim, which I modestly call Schechter's maxim, which is that economies change faster than perceptions and perceptions change faster than politics. The kinds of changes that have been going on in the Northern Rockies, in the A9 communities, they are not going to slow down. And we are looking, if you look to governments for solutions, which is what we're tending to do, that's a fool's game. And the reason for that is because these things are changing a lot faster than we can recognize them. Those forces are going to continue to go on. The basic point is that all these people who are moving into our region and into our community are going to have someplace to live. So if you're a developer, there's going to be continued growth. It may not work as an investment, as you heard in the previous talk, but it's going to continue to be there's going to be a lot of demand out there. If you're a policymaker, things are only going to get more complicated. If you're a nonprofit leader, you'll probably be asked to do more and more to keep the fabric of your community together. So with that, I've gone over my time. Thank you very much. And if we have time for questions, I'd be happy to answer. Thank you.
Just going to wrap up with a couple quick questions. I know these gentlemen will be around for you to buttonhole them later to quiz them on their thoughts. One question I had was, for this region itself, a lot of people who moved here in the last decade, like Jonathan Weber, come from very expensive real estate places to relatively less expensive. What kind of economic benefit does that give to the region, and what kind of impact would that have that would make this region, say, react differently as the real estate market cools around the country? Maybe, Chris, you want to try to address that?
Well, obviously, when you move from a place like Los Angeles to Montana, you bring a lot of wealth. And with wealth comes demand for a lot of high-end services, and I think that drives the overall economy upwards. I agree with 98% of what Jonathan said. The 2% being, I think, again, it's trends and bends. All his trends are 100% right. And I think they may stumble a little over the next couple of years with the cooling real estate market, but I think that the stumble will quickly turn back into a good, solid pace again. So, but I think that overall, I think it's a positive thing. But of course, the politics of that are shall we say, controversial.
Well, the really interesting thing about this is that 15 years ago, you didn't have the freedom. You couldn't telecommute across a city, much less telecommute across time zones or across the world. The same forces that are taking computer support out to India are basically allowing somebody like Jonathan Weber to move anywhere he wants to in the world. He happened to pick Missoula. And that kind of thing, it does bring a tremendous amount of wealth. It brings an awful lot of other forces of change, some of which are good, some of which are bad. It creates this incredible pressure within a community, I believe, and I think you can see it throughout the Northern Rockies. You have people who are living in Missoula today, or Bozeman, or Jackson, or any of these places. They're 4th, 5th, 6th generation, and they can remember when things were very much like they were for their grandparents and their grandparents' grandparents. And then you have people coming in, and they see it as a very, very different beast altogether. And that tension between the newcomers and people who've been there for a long time, it plays out in what happens to community character, it plays out in affordable housing, it plays out in the stresses of quality of life. And those are very real, and nobody's figured out a way to handle them, because this is all a 10 to 15-year-old new phenomenon in human history.
That's a great way, I think, to wrap up, just to explain what a central role development real estate is playing in this region, and how people coming to this region, as well as the wealth, the financing, the history, all those issues that I'm sure will be addressed throughout the rest of the day. I want to thank you guys for your great presentations. Thank you very much.